Ever heard the term financial derivative and immediately felt a little lost? You're not alone. It sounds complicated, and honestly, it can be. But understanding the basics is becoming increasingly important, especially in today's financial landscape. Let's break it down. So, what is a financial derivative? Simply put, a derivative is a contract whose value is derived from the performance of an underlying asset. That underlying asset could be anything: a stock, a bond, a commodity like gold or oil, a currency, even an interest rate. Think of it like a bet on the future price of something. It doesn't involve owning the asset itself, but rather a contract based on its future value. Now, why should you, as a U.S. resident, care about these things? Well, derivatives are huge. They're used by everyone from farmers trying to lock in prices for their crops, to major corporations hedging against currency fluctuations, to investors trying to speculate on market movements. They play a significant role in the U.S. economy, and understanding them can help you make more informed financial decisions, even if you don't directly trade them. It's about understanding the risks and opportunities around you. Let's look at a simple example. Imagine you're a corn farmer. You're worried that the price of corn might fall by harvest time, meaning you'll make less money. You could use a derivative called a futures contract to lock in a price today for the corn you'll harvest in a few months. Let's say the current price is $5 a bushel, and you agree to sell your future harvest at that price. Even if the price drops to $4 a bushel by harvest time, you're protected. You'll still get $5. This is a way to reduce risk, a core function of derivatives. Conversely, someone else might buy that futures contract, betting that the price of corn will rise above $5. They're speculating, hoping to profit from the increase. That's the other side of the coin. Derivatives aren't just about reducing risk, they're also about taking it. So that's the general idea. Now let's look at some common types of derivatives. There are four main categories: forwards, futures, options, and swaps. We've already touched on futures contracts. Forwards are similar to futures, but they are customized contracts negotiated directly between two parties, rather than being traded on an exchange. This makes them less liquid, but allows for greater flexibility. Think of a coffee shop agreeing to buy a specific amount of coffee beans from a farmer at a set price for delivery next month. That's a forward contract. Next, we have options. Options give you the right but not the obligation to buy or sell an asset at a specific price within a specific time frame. There are two main types: call options and put options. A call option gives you the right to buy something, while a put option gives you the right to sell something. Let's say you think the stock price of Apple will go up. You could buy a call option, giving you the right to buy Apple stock at a certain price. If the price goes up, you exercise your option and profit. If it goes down, you simply let the option expire, limiting your loss to the price you paid for the option. Finally, we have swaps. Swaps involve exchanging cash flows based on different underlying assets. The most common type is an interest rate swap, where two parties exchange fixed and variable interest rate payments. This is often used by companies to manage their interest rate risk. Imagine a company has a variable rate loan. They're worried interest rates might rise. They could enter into a swap with a bank, agreeing to pay the bank a fixed rate in exchange for the bank paying them a variable rate linked to the same loan. This effectively converts their variable rate loan into a fixed rate loan, providing certainty. Now, derivatives can be complex, and there are risks involved. They can amplify both gains and losses. Misunderstanding them or using them improperly can lead to significant financial consequences. The 2008 financial crisis was, in part, fueled by complex derivatives that were poorly understood and mismanaged. To recap, a financial derivative is a contract whose value is derived from an underlying asset. They're used for both hedging risk and speculating on future price movements. The main types are forwards, futures, options, and swaps. Understanding these instruments, even at a basic level, is becoming increasingly important in today's financial world. They're powerful tools, but they need to be used responsibly. Remember, this information is for educational purposes only and should not be taken as financial advice. Always consult with a qualified financial professional before making investment decisions.